Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Sam wants to know, what are your thoughts on treasuries being in a bubble? Seems like people are beginning to short the treasuries, or I guess I'm adding this point, or is it just everybody was just too long treasuries? What do you think there on the bubble and treasuries?
I think there's a couple points here, and we wrote about this today to our subscribers. Number one, the Treasury's got a massive risk move when the globe, almost broke down. Everybody around the world ran into Treasuries. So the move that we saw, the big rally we saw, was a giant fear move in Treasuries. And again, there's where the world reserve currency status helps the U.S. People had to hide in our capital markets because they were the deepest. So part of that coming out of there is the natural process of people coming out of that risk trade back into the risk appetite trade. A lot of that move. The big move in Treasuries, I believe if you go back and look at the move, you'll see it directly tied from where the credit crunch started, and we haven't even retraced there, I don't think, yet. Secondly, this idea of monetization of debt by the Fed, I think, is really scaring some people out of some of these treasuries with the idea of the potentiality of long-term inflation if they don't mop this stuff up, as we say. I think some of that is real coming into the treasury market. But so I think you have a dual sell-off there. Again, if you look at where we were, back in 2001, 2007 time frame even, we haven't even retraced to there. So I don't think it's as serious a move as people are implying, even though because it's been so swift. Also remember this, and this is something that we wrote as kind of just in my head, so to speak. How do banks make money in the U.S.? They borrow short and they lend long. Is the Treasury and the Fed smarter than we think? Being very happy with Treasuries falling off, meaning long-term yields rising, the banks can reliquefy themselves. It would give them a market reason to do more lending instead of having all this reserve sitting on their balance sheet, and could lead to some self-generating lending in the market because of the spread on the long and the short end widening again, which goes right into bank profits. So it's not necessarily all a bad thing in here if you look at it from that perspective too.
That's interesting. I love that point that you talked about earlier on about mopping up. I read a book once, and I'm sure you've read this many, many times, about the Fed and sort of that metaphor of the punch bowl, that they have to take the punch bowl away just as the party gets going.
Right.
What do you think of that? The idea that they really do have to take this punch bowl away. Maybe it's not this month or 6 months from now, but at some point, that's going to be the real challenge, is politically, nobody's going to want them to take that punch bowl away.
Yeah, you're exactly right, Steve. And we're already seeing the battles. Some of the Fed members, various regional Fed banks. Fisher came out the other day saying this is a real problem. The Fed has to start mopping up now. They've put so much money in the market. But the reality, it is not politically palatable to even talk like that in Washington at the moment. And that's that risk premium that's starting to flow into the market, I think.
One or two more, Jack. Ed wants to know, are there any smoke signals portending a shift in currencies being revalued on the part of worldly sovereign nations scenarios? I don't know if he means China or anything else. What do you see? Or maybe that's time for another webinar.
Of the major currencies around the world, they're all floating. So in terms of their ability to manipulate up and down, they don't have that at the moment. China does have the ability to move their currency as they want. China is still banking on some type of V-shaped recovery in the global economy rebound, and they're very happy to have their currency values as low as possible. So they're not as unhappy as people would think with a falling dollar, because it tends to, again, increase their export competitiveness here. So I don't see a lot of hot money moved into China expecting a one-off big increase revaluation from the Chinese in their currency. But I think they underestimated how powerful the export economy was to them, and how nervous the Chinese are about any appreciation in the currency that could impact exports. Exports is what they think, and from that standpoint, I don't see a one-off revaluation in Chinese currency. In fact, I don't see an appreciation in the Chinese currency if we maintain this cycle for a long time, until they finally get to some modicum of a domestic demand. Of the other smaller countries in the world, there's not that big of an impact on them, but the majors just can't revalue and their currencies and devalue when they want any longer.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.